Hello, and thank you for joining our webinar today, where we will be covering how financial institutions can stop silent attrition with AI-powered marketing. Just a few housekeeping items. Please drop any questions that you might have into the chat. We will try to address those as much as possible during the webinar, but if we can't get to your question, we'll send you a follow-up email. Towards the end of the webinar, please keep an eye out for a very brief poll. We would greatly appreciate you taking a few moments to respond to that. My name is Rachel O'Neill, and I'm a Principal Solutions Engineer here at Alkami. I specifically cover our data and marketing solutions. And with me, I have an expert panel that I would like to introduce. So let's begin with Mark Lair from the Alkami team.
Hi, thanks, Rachel. Yeah, my name is Mark Lair. I'm a Director of Product Management, also focused on our data and marketing solutions. I've spent the last 20 years of my career really in data and metadata and taxonomy, and a big portion of that on FI transaction data. So looking forward to the conversation today.
Thank you, Mark. And joining us from Capital Credit Union in Green Bay, Wisconsin, we have Steve Zeke.
Hi, everybody. Steve Zeke, Chief Marketing Officer for Capital Credit Union. Been with the credit union now in my role here for a little over a year, but been in the financial space for about 5 years and in marketing in general for 20 plus.
Wonderful. Thank you, Steve, for being here. And from Steve's team, we have Will Johnson.
Hi, everyone. I'm Will Johnston. I have been with Capital for 3 years. I've been in the financial world for about 9 years, working my way up to being a marketing analyst. And that's currently what I'm doing for Capital.
Awesome. Thank you, Will. So now let's dig in. So to understand attrition, we have to understand consumer behavior. And on screen, we have the typical stages of the American dream, if you will. And now we could absolutely debate the order of these stages, but what we can agree on is that most people are now living life very differently than they used to. And that dream of the white picket fence really isn't for everyone. A lot of us are moving these stages around. And over the next 10 years, $16 trillion in wealth will be passed down from older Americans, primarily to millennials, who are anywhere from 27 to 42 years old. And now that's a huge age range. And hopefully most 27-year-olds are living differently than 42-year-olds and vice versa, but you never know. People can choose whatever life they want. But whether they're a 27-year-old millennial or a 42-year-old millennial, or even Gen X and the up-and-coming Gen Z who's already graduating from college, most of your current and future high-yielding account holders have grown up with technology. They've really had technology in their lives forever. So these people, myself included, have a technology dependency. Their banking behaviors are no different, and they go straight to Google to find what they need. And they really turn to whoever makes it the easiest. And they will leave you without the smallest trace of dissatisfaction. They probably won't even leave a bad review or have a bad call center call. I actually did this over the last few years, and my bank that I've been with since I was 16, they didn't have a high yield savings account. It wasn't on their website, at least. So it wasn't easy for me to find. So I was looking for this, on a weekday after work, or even on the weekend. I couldn't find anyone to chat with. Their rates weren't on their website. So what did I do? I went to Google and I came across another bank, opened an account online, and transferred my money out. Now, there were a few breadcrumbs, though, that my bank could have paid attention to. And that's something that we're going to talk today about, is the breadcrumbs in the data. They could have seen that I visited their website and looked at their CD and their savings account content. They could have seen that I had trial deposits hit my old account when I was ready to transfer from my new account. And these insights were there for this small $180 billion bank that I've been with since I was 16. But they weren't paying attention. Now, we know this isn't easy for banks and credit unions to do, no matter the size. You're not a technology company, but your job is to help your account holders live their financial lives. So some of our primary research has found that financial institutions really face these 4 challenges, and they're all related. They all have to work together to create a culture that's grounded in data. You have to be able to unlock data. And when you unlock that data, it has to be easy. No manual, pull a list here, pull a list there. Hey, data and IT, query a database for me. It has to be easy to use. It has to be secure and compliant. And finally, for the marketing team, you have to be able to prove your ROI with the technology. So I want to open this up for Steve really quick. Thinking about capital and your team, you're very grounded in how you utilize data. I think we're all data geeks on the line here, at least. When looking at these 4 challenges, how do you work cross-functionally to empower your marketing team to be successful to overcome these challenges?
Yeah, so I love this chart because I think from any marketer's view, this tells probably the whole story in a nutshell. You know, every marketer has that challenge of, you know, having to prove the ROI, you know, really understand the data. And, you know, from our financial standpoint in our industry, you know, manage the compliance of it all and then making it easy. So how do we do it? Well, you know, it takes a lot of work, but, you know, cross-functionally, our teams do a really great job of digging in. So you know, I have a great team here when it comes down to the data, looking at it. It's not so much about, you know, the data, you know, using the data in a way that it tells us what to do. We allow the data to inform us. And by allowing us to let it inform us, that really drives, you know, to making it easy and then returning that ROI across the board and telling that story at the end of the day too. Because if we allow that data to inform us, it makes the story a little bit easier to translate.
Absolutely. And growth is a team sport. So you've all got to work together, and it's great to have, you know, you could do hunch marketing, but then that only gets you so far, and then the data could lead you to what you want. And then if you have to use your gut, you could, but hopefully the data takes you where you need to go. Okay, so Mark, you've been, like you said, working with data for 20 years. You've built taxonomies across industries. Can you talk about unlocking the data really in the upper right, how unlocking it in the upper right-hand quadrant unlocks all the other 3 quadrants?
Yeah, and what appeals to me, I like this slide too, Steve. I agree with you. What appeals to me most about this whole slide is the no more list pulls. So if you think of the setting a foundation of organizing all your information, all your data, so that you can quickly, instead of the traditional list pull, as you go to your data analyst and say, hey, could you find me a list of people who are sending money to cryptocurrency exchanges, and they're going to go try to figure that out because the transaction descriptions might be confusing and there might be 10 providers, and they need to go gather all that. They come back in 7 or 10 days with the answer. That's a long time. And so if you start with a foundation of we're going to be a data-driven organization and we're going to organize our information, truly unlocking it, that sets you up as an institution to quickly create whatever segmentations you want, do some testing and measuring of the ROI, and coming back and adjust. And I love it because it's something that will serve you in any environment. 2 or 3 years ago, FIs might have been more interested in lending and mortgages. Today, the topic is very much around deposits. Those are different marketing stories and different segmentations that we may want to create. And if you have a great, strong data foundation, that certainly makes it easy. And it just flows into this entire virtuous cycle.
Yeah. So at the blink of an eye, you could switch your strategies as the market changes, because eventually we will be back in that lending market. You know, it happens every few years, so it'll definitely come back. I'm not exactly sure when yet. So a little bit later on in the conversation, we're going to specifically talk about attrition modeling and understanding and how to predict attrition. But there are other ways that you could leverage AI and machine learning to better serve account holders. Capital Credit Union has been doing a great job at identifying the right audiences for a variety of products and services, everything from deposits and home equity and auto lending. So I want to dig into the first campaign. And Will, I know, is a great power user of the platform, and we love this multifaceted CD strategy here. There were actually 2 different campaigns running and 2 different offers. So Will, can you share a little bit about the process and how you decided who to target and what the offer was, and then just explain the outcome of the effort?
So basically we had 2 campaigns going. So we had two products that we were offering. So we were offering a certificate special. So one was a normal certificate, we'll call it. And then the other one was a certificate jumbo. And basically the jumbo, we were going after people that had a larger dollar amount. So when creating those equations for the first one, the AI generated KLI selection one, that was a blended version. Basically, the AI generated KLI is basically anybody with competitive investment, savings, bank transfers that we may have saw through SEMA, and then the deposit trend. So anybody that had an increased withdrawals of up to 50% of their money, we were able to track that. And that kind of goes along with your breadcrumbs. We're able to see that. And if you didn't have SEMA, you might not be able to recognize that they might be leaving. And then if their deposit trends have gone down as well, they decreased by 50%, then that was another way. And then the money market ALI or KLI that we had, we put that in there because I look at the AI to benefit capital, almost like a collaborative effort. So basically it's like a fishnet. It's able to catch the ones that we may have missed. And it was able to do that. So combined with the help of the AI, the money market KLI, we were able to generate 1,214 prior influences. And then for the human only one, again, like I said, that was a little bit more of a jumbo certificate. So we went after the high rollers. That's what we're going to call it. Anybody with a balance above $250,000. And you can kind of see if you look at the numbers on the right, we may not have had as many influences for the human only one. But the average face value was 59,000. So there definitely was an increase. But overall, it was a very successful campaign.
Between the two of these, generating what, $43 million between the two campaigns. I don't know about you, but that seems successful to me. You guys set your own goals internally, but that seems pretty impressive. And you were able to target different groupings. So that kind of ties back to the beginning, like everybody has different needs. We all live our lives differently. You looked at competitive spending, but then you also used other AI to kind of bring together anybody who could potentially benefit from a high yielding CD. That's awesome.
Yeah.
So, Steve, Capital, like we said, you're running a variety of campaigns and you haven't been 100% focused on just deposits. We're obviously spotlighting a deposits campaign here, but we even have some institutions we talk to who are having a strict no lending approach because they really need deposits. So from the top down, and we talked about this a little bit before, how do you strike the right balance of meeting your members' needs and driving growth for the right products and services?
Yeah, that's a great question. And it's the $1 million question right now. I think a lot of financial institutions are, in their boardrooms trying to, really strategically, plan out. And for us, we sit in a pretty good spot, and we're not so much limited on what we can lend, or we have to pull back a little bit here or there. Now, that doesn't mean that we aren't really keeping an eye on that loan share value, and understanding that we need to bring in X for deposits or X for loans to be able to make sure that we're always providing our members the value that they expect from us. So for ourselves, what I love and what we try to do, especially when I set out the marketing strategy and we're working with the team, it's really understanding, okay, at what point in time do we need to move a certain product or service. And by doing that, we can determine what levers to pull. And what I love about it is it allows us to really dig in and be able to do that and zero in certain areas where if we don't want a flood of something, we can make that happen. And we can still target a specific audience and go after them because of the high propensity that we're looking for. And we can limit that, based off of the KLIs that Will is able to build. And we can build campaigns that are really strategically prescriptive in a way to move the needle. So and I think this is a great example that Will shared here of being able to not only use the AI portion, but also use the human element, as he put it, have that fishnet out there to make sure that, we get maximum, efficiency out of the platform. So for us, it's about striking that balance and really knowing what levers we have to pull and then pulling them at the right time. Now, we're not always going to be perfect and right when we pull those levers, but this right here is a great example of allowing us to get pretty close to that bullseye.
I love
Absolutely.
that. I love that answer. Sorry to jump in, Rachel. Steve, when sometimes people think of marketing as just, oh, it's just getting our brand out there and it's just growing and a very surface view of the department. Really, marketing is something that pulling the levers. It helps you tune to the strategy that your credit union is trying to achieve.
Absolutely. It's a lot more than branding and branch marketing. Well, that's a big part of it. It's serving everybody's needs and understanding consumers' needs, like we talked about. So, thank you, Steve. So Will, when you both decide on a strategy, hey, we want to go after CDs, here's some things that we're thinking of. How long does it take for you to then create the campaign, identify the audience, and deploy it?
It usually goes pretty quick. Steve and I talk a lot. We basically go through everything step by step. So as soon as we talk about it, I go right to my computer and I get right on and I start to input things that might be for a CD. So for example, money markets right now, money markets are kind of on the downturn a little bit just because CDs are so high right now. The certificates are so high. So they might be a good opportunity to offer your member what's best for them, even though that may not, or that may be taken away from money markets. So that's a good example of that. But then anybody that just has money sitting in their account, and those are the things that Steve and I kind of talk about, and that's how we're able to come up with these equations. And it goes for any product, whether it's credit cards, checking accounts, CDs, home equity loans, and that's kind of how we do it. And we go through it pretty fast. It probably takes about an hour, 2 hours. Like once I get into Seaman, I can put the equation together. It's good to go. So
Yeah, you can hit the ground running.
yes.
And I think one important element to this too that Will and I really, when we have our discussions and we really talk through these things, and we're trying to get better at this as we go along, because there's so much data, and if we go back to that one of those beginning screens where when we talk about unlocking that data, and I think it's mentioned somewhere in there like how financial institutions have so much. We have access to knowing a lot about our members and their behaviors, and you can get lost really easily and go down this rabbit hole. But what Will and I really like to try to do is when we get to that point, we always ask ourselves this question: is like, can we test it? And we're trying to get really better at the fact of putting in more testing. So even if it's a smaller audience, to be able to get a gauge of whether or not is this the right timing, is this the right audience to go after, we try to apply that, and it takes a little bit more time and effort, but I think it's in this day of marketing, it's critical, so critical for institutions and agencies alike to throw in that element of testing, because if you're not testing, you're not learning, and you're ultimately throwing spaghetti up against a wall and hoping that it sticks.
Absolutely. So a test and learn culture is huge. That fail fast mentality, not that anything you've done is fail, but if you're going to, fail fast, fail small. And we all move on from things, like us as consumers, we move on from things so quickly, like everything's just changing so fast. So you have to respond to that as well. Which I know this next campaign was kind of that test for you. So this is a really creative example, and it's more of an A/B test of our AI home equity model against your human generated model. So Will, can you walk through first, probably this human generated selection here at the bottom, and what was the process for launching this HELOC campaign in the fall?
So the human only generated KLI selection for that campaign, we decided to go a little more targeted with that. So, and we tested it. It wasn't really a big audience. So as you can see, it was only 1,400 impressions. So we targeted student loans. And around October is when we launched this, or late September. And that was when student loans were unpausing. You were gonna have to start paying them. So we thought, why not try and see if there's anything here? Use the equity in your home to help pay for those student loans, or decrease the payment, or speed it up a little bit. And so that was kind of the thought process with that. And then obviously, as you can see on there's consumer mortgage, competitive mortgage, anybody that has those, they might have the opportunity to do that. And then with this being such a small campaign on our end for that portion anyways, we thought, why not use the AI for home equity? And we did. And we had that as its own separate equation. So we did an A/B test on that. And as you can see, the impressions was almost 8,000. We had 52 influences or lifetime goals, and it brought in 2.6 million. And then for the student loan one, it was 1,400 impressions. And then we had 13 influences or lifetime goals. And now when you look at this, you may be thinking, oh, well, AI completely killed it. Honestly, I look at this as a good partnership, because when you do the numbers, the impression efficiency, so for the AI, that means every 152 people that this made an impression on, one person funded a HELOC. And then if you go down to the human only one, for every 112 impressions, that means that one person funded their HELOC. So in a way, it may look like it's not good, the human only one, but you have to look at it that it's a good blend. It's a good blend because you have the fishnet to catch what you would have missed, and you're able to test something that you normally wouldn't have. And that's kind of how we thought about the campaign for that one and went about it. So
I think they both look great. And in total, collectively, it was over $3 million in new HELOCs opened in a very short period of time. And another way to look at it is 13 people who had, competitive student loans, competitive mortgages, brought back a loan back to capital. And you were helping them. I know a lot of people who, really rode high on not having student loan payments for quite some time. And then, reality set back in and they had to start paying $250 or more a month. So it's helping at least 13 people. And then, there was a bunch of other opportunities out there that the AI model caught as well. And you're doing exactly what we've been talking about, is that test and learn. So you, Steve and Will, you do a great job, getting creative, but also limiting your risk. So thank you for that. And I don't know if on these case study slides, if there's anything else that you guys want to chime in with at this point, and then we'll start digging into attrition modeling specifically.
Well, the only comment I'm going to just throw in on this one, and Will didn't really touch on this because this was the fun part of about this, and this is where we kind of geek out as marketers, in a sense, and that is when we had the ability to an opportunity to test this and kind of take the human element and go up against the AI. We kind of made it a fun little like game of it. And Will saw it as a competition, a competitive opportunity to say, can I beat the AI? And this isn't the only campaign that we ran where we used AI and said, okay, where does AI fit in the sense to help us capture what we missed when we built these KLIs manually, and how do we leverage both and get as much out of it as we've mentioned before. So I think the fun part to this is if you're a true marketing geek, you will love being able to do this in such a way. It makes it a fun challenge.
So do you ever have to control yourself when you're digging into the data? Like, okay, we've dug enough, let's pull back out and do something.
Yes, sometimes. Yeah, we have. Sometimes there's going to be times when I'll go back to Will and I'll be like, hey, I was thinking of this. What if we look at this KLI and we added this to the soup? And Will's like, well, we could, but this is what happens. And it's really interesting because it allows us to go back and forth a little bit, and you bounce these ideas. But again, you gotta kind of you gotta watch yourself a little bit too, because you can easily go down that rabbit hole and get distracted, and then you always end up in that space of paralysis by analysis. So.
Absolutely. And Mark, I heard you got a new competitor. His name's Will Johnston. He's trying to outbeat your models. Okay, so foundationally, for any predictive model to work, it needs to be trained. And Mark, can you talk a little bit about our approach to cleansing and curating data? Will and Steve have talked about our KLIs, and let me just give context on that. KLIs are key lifestyle indicators, which are metadata tags. So if you could talk a little bit about our approach to tagging, cleansing, and curating the data, and then how that informs all of our models.
Yeah, absolutely. So organized data well-labeled data is a critical component to going into an AI model. It's kind of a garbage in, garbage out. We want to have really clean, nicely labeled data when we're doing our training. So the process of creating an AI model is we're going to identify a group of account holders who have exhibited the behavior that we wanted. In the case of a HELOC, it would be they opened and funded a HELOC. In the case of a mortgage, they opened a mortgage. In the case of attrition, it might mean an event where they close their accounts. And so now once we have an example of account holders who have done that, our AI platform is able to generate a model. I think of it as almost creating like a KLI fingerprint. It looks at all the KLIs that we have, and it determines in an unbiased fashion which of those KLIs had the most predictive power, the most predictive influence of that event, kind of looking back 6 months from when that event started. And based on that, it's going to generate that fingerprint or that model. And now we can take that model and score all the other account holders and see who looks a lot like the people who previously took that, who previously kind of fell into that target scenario. And now we can generate a population for someone like Will and Steve to target. So I love the conversation about human versus AI. I think Will showed the human analyst and his expertise as an FI marketer brings a lot. And then AI, it's almost a new diversity of perspective. It's bringing a perspective from the AI. What would a good audience look like? And you put those two, human plus AI, together, and you get a great mix.
That makes a lot of sense. And so we launched our attrition model, 3 or more years ago at this point?
Correct.
What have we learned, and your team, what have you all learned, and how did that inform our thinking of the importance of silent attrition as well as engagement as a whole of each member or each customer at an institution?
Yeah, I love talking about this. When we did launch our attrition model, and this was the very first AI model that we had developed, and we went with attrition because we heard from FIs how important they're losing account holders every month and how expensive it is to get new account holders. And so if we could stop that flow of people leaving an institution, how beneficial that would be. And so we developed the model. We trained it, like I said, on account holders who had closed their accounts, and we looked at their behavior, and we were able to create this risk profile, which is called an attrition risk positive audience, based on the outcome of that. And as our FIs began to use it and we got feedback, what we found out is that the people who are attrition risk, they're really hard to engage with. They might have already broken up with you, so to speak, and they just didn't let you know that. And so our FIs really struggle with, like, well, how do we get in front of these people? How do we get their attention? The other challenge with attrition is, unlike opening a HELOC where there's like a celebration, pop the champagne bottle moment, we know that it's happened. You never really know if you've stopped attrition. You see people that have left, but no one in that audience is picking up the phone and they're saying, Steve, Will, thanks for your campaign. We've decided to stay. And so you don't have that champagne popping moment. So there's just something generally kind of dissatisfying about it. And what that taught us is that it's not really that moment of attrition that's important. It's brings us to the idea of silent attrition. We need to engage with the account holder well before they've closed their account, well before they're close to closing their account. Engagement really starts on the day somebody opens up an account. So we actually expanded our attrition model. The great thing about our approach is when we did the scoring, those that scored very high for attrition risk, that we were delivering that attrition risk KLI for, we could also look at the full spectrum. We scored everybody. So those that scored very low for attrition risk or medium for attrition risk, we looked at their behavior. We found out they're really engaged. They had a lot of balance movement with the FI. They had lending and transaction and savings products, so a rich mix of products. We saw a lot of transacting with merchants like Walmart and grocery store, not because people who go to the grocery store are loyal to their bank, but it's because they're using those bank products. They're truly engaged. And so now this is a tool that an FI can use to look at the entire spectrum of engagement. And instead of just worrying about somebody who's really at the attrition risk, we can see the whole spectrum. So if somebody is low engagement, well, what does that mean? Are they too far gone, or can we still get them to increase their debit card? Or if they're high engagement, what we see there is those people tend to already have all the products, so maybe they need more utilization. Let's continue to engage with them. Let's not take for granted our best account holders, and make sure they never get to the point where they think they're taken for granted and they're going to move their money to the a digital bank or to Apple Savings or wherever people can move money now.
There's a lot of great points there. And I think it is also validating, Will, to what you were doing with the student loans and the competitive. While it might not seem like it was the pop champagne moment and didn't get as many conversions, you were still retaining members because you're helping them in a moment of need, and also boosting your own PFI status with that member, because the more accounts they have with you, the more likely they are to stay. And I think, Mark, one of the things you were referring to is called ghosting. At least that's what they call it. The kids call it in dating. Is people today, when they're going to leave you, they're just going to ghost you, and they really aren't going to let you know why or when. But there will be a few little breadcrumbs in the data, such as changes in transactions that AI can pick up on.
Well, that's why cross-sell is so important. And we featured a couple cross-sell campaigns within this silent attrition webinar. Think how valued an account holder or one of Capital's members would feel when they are starting up a student loan payment and Capital comes in with a solution of a HELOC to help address that new loan payment. That's what that's what members want. They want to know that their institution cares about them.
Absolutely.
And I think, if I could just jump in real quick and just comment, what you've been talking about here, Mark, is spot on in terms of, I think of ourselves I think I could speak for probably the majority of financial institutions out there and those that are with us today. And that is, the attrition risk and understanding who has that high risk of leaving is one of the things that we're always looking for, because we live in an environment nowadays where, I think we got to redefine the idea of what loyalty is to your financial institution. What is that? What does PFI really mean? Because I think a majority of people have multiple accounts and have relationships with multiple financial institutions. So to establish a true PFI is what everybody's trying to do. And nowadays, understanding what, I guess you could say, what are those behaviors that are forcing somebody to rethink that relationship from deepening it with your PFI is something that we're all really trying to go after. What I also think about, and these are conversations that Will and I have had too in the past, is we have all these different, again, I'm going to go back to that analogy that I used prior. We have all these different tools, all these different levers that we can pull. I think what marketers need to really understand, especially in the FI when we're using these tools, is how do you marry this with everything else that you're doing? If you're going to be truly successful at this, you need to be able to know how to make the glue stick, so to speak. And I think that's the real trick. And that's something that we're still trying to get better at every day.
Test and learn, test and learn. And that's where tracking your ROI and having the data there helps you understand what is and what isn't working. So, Mark, one more thing we wanted to uncover, and this seems obvious, that direct deposits is often seen as the holy grail of criteria on someone's checking account. And a lot of people or modeling companies out there, they basically create a checklist of criteria for a model. Can you explain, first of all, what this chart is telling us about direct deposits and attrition, but also how modeling can't be just a checklist of criteria?
Yeah. we've talked about geeking out a lot. This is a slide I really geek out on. So when we dig into the details, I think it's really illuminating to the value of data. So what this chart is saying is this is a kind of an aggregated view of a few institutions, but we did our attrition, our full engagement model. So we have red, orange, green, yellow, green from attrition risk positive to high engagement. And then another thing we learned really with all our AI modeling, but the attrition and engagement specifically is institutions were always interested in, well, what do I do? Or like, what does this mean? I know their attrition risk. How do I influence that? Or their high engagement? What should I do next? And so the whole universe of other metadata values can help provide that context. So this is a simple view where we looked at, did they have direct deposits in the last 90 days and charted based on the attrition and engagement level. So if we look at those who had no direct deposits in the last 90 days and we see that more than 75% of the low engagement and attrition risk did not have direct deposits. And about 60% of the medium engagement and about 35% of the high engagement. So this says, if we look on the other side, more than 50% of high engagement had direct deposits, while a relatively small number of attrition risk and low engagement had direct deposits. Okay, well, no duh. So maybe an FI could just say, if you have direct deposits, you're engaged. If you don't, you're not engaged. And that would be a simplistic view. But what's really interesting to me is that 10 to 15% of the low engagement and attrition risk positive who do have direct deposits. So when we think about the challenge of engaging those that are attrition risk, it could be that 80% of that audience, they have ghosted you. They're really going to be hard to engage. And so as an FI with limited resources and we want to target, maybe we're going to have an executive call them up. Here's the set. They have a direct deposit with your FI. They have their paycheck is going to your FI every 2 weeks. Why are they attrition risk? Maybe they're worth a conversation. If we were to double click on one of those tabs and look, cross-section it with something like balances, maybe it's those people who have direct deposit and a balance above $10,000. We can get from a really large audience of attrition risk that might be hard to manage down to probably 150 or 200 really valuable account holders who do have meaningful activity with your FI that they're worth checking in with. Like, why are you disengaged, or why are you at risk of attrition? Of course, not phrasing it that way, but hey, we want to see how the relationship is going. Is there anything we could be doing better? So engagement really gives you a lens through which to view your account holders, and then all the other KLIs give you some tools. That's again the benefit of AI plus human. It gives the human being who really knows their account holder base a lot of ways to segment and figure out, well, where can I have the most impact?
That makes a lot of sense. And I think that's also what's important about the modeling is looking at the changes in behaviors, because if Steve never set up direct deposits, that doesn't mean he's at risk. That's just not how he uses his bank account with you. But maybe if he had a change in behavior, and that's really what you said a few slides ago, is that the AI modeling also picks up on the changes in behavior. Maybe Steve once had direct deposits and then that's been dwindling and now he has zero. So when we look at it flat, like we are in this chart, it's not telling us everything that we need to know, but the data tags give you the contextualization of, okay, who do we prioritize? Who hasn't slammed the door on us yet? So we could put in a little extra effort and save that relationship.
Exactly. It's like the three-dimensionality to kind of tie a bow on it. If I just assume that people who have direct deposits are engaged, now AI is telling me there's actually a segment that's not engaged. And they're the ones I should be concerned about.
I just want to thank everybody for attending our webinar. Steve, Mark, Will. Is there anything else, any other parting words for any of our attendees, anything about data, marketing, credit unions, banking in general? Just want to open it up and see if there's any other parting words from the team.
No, I just want to thank you for the opportunity to share our insights and kind of our experiences thus far.
Absolutely. We're honored to have you here. I can't thank you both enough for choosing Alkami's data and marketing platform and really being an advocate for us. So we really appreciate you. And we hope you continue to utilize the platform and push us to keep innovating. You're exactly the type of clients that we like to work with. And thank you everyone for attending the webinar today. We apologize if we didn't get to your question yet, but we will follow up through an email. Before exiting the session, please take the quick poll that's on your screen. And thank you, Mark, for building such an awesome product and joining me today and sharing your expertise.